Hello friends and welcome to Coin Engineer YouTube channel. The 14th video of our Introduction to Technical Analysis series is price formations and how to use them. But before we start, I would like to say that you can have all the crypto information you need for free from our YouTube channel. So do not forget to subscribe and keep the notifications on for our upcoming videos. A chart formation is a pattern in the price data that a trader uses to anticipate what the price may do next, based on how that pattern played out when it appeared in previous circumstances. Chart formations are essential in the practice of technical analysis, whereby traders attempt to predict future movements in an asset's price by studying the past changes in price and volume. Chart formations have different probabilities attached to them, as the price won't always move as expected when a formation occurs. A trader must watch chart formations to see if the price stays in the pattern or breaks out. Either of these situations presents potential trade possibilities. There are many types of chart formations or chart patterns that traders use to predict future price changes. Some widely followed chart formations include the double top and bottom, head and shoulders top and bottom, rising wedge and falling wedge, triangles, price channel, and cup with a handle. Chart patterns are tradable, but there are multiple ways to trade, like breakouts, false breakouts, continuations, etc. And for that reason, always remember, chart formations are best to use in conjunction with other forms of analysis such as technical indicators, trend analysis, price action, and fundamental data. Candlestick patterns are distinctive formations created by the movements of prices on a chart. Pattern can be recognized by a line that connects common price points such as closing prices or highs or lows during a specific time. There are more than 40 candlestick patterns, but the ones that you see on the screen are the most popular ones. A black or red candle represents price action with a lower closing price than the previous candle. Meanwhile, white or green candle represents higher closing price than the past candle. The area between open and close, called the body, and the price excursions above and below the body are called wicks. Wicks illustrates the highest and lowest traded prices during that specific time frame. Meanwhile, the body illustrates the opening and closing prices. Price range is the distance between the top of the upper wick and the bottom of the lower wick moved through during the time frame. This range is calculated by subtracting the low price from the high price. If the asset closed higher than it opened, the body is hollow or green, with the opening price at the bottom and the closing price at the top. If the asset closed lower than open, the body is black or red, with the opening price at the top and closing price at the bottom. Ergo, the color of the candle represents price movement relative to prior period's close, and the fill of the candle represents the price direction of period in isolation. And that is it for today. I hope you have enjoyed our content. If you did, please drop a like under the video, and if you would like to see more of our content, please click on the subscribe button. Thank you for watching and take care. Until next time.